The automotive industry is making a significant U-turn after a couple of years marked by over-optimistic electrification efforts. Initially hailed as the future of transportation, electric vehicles, EVs, promised a cleaner, more sustainable alternative to traditional internal combustion engines. However, recent events have forced a harsh reality check upon the industry. Issues such as frozen EVs, malfunctioning chargers, and widespread job cuts are just a few of the clear indicators that the much-anticipated EV market collapse is now unfolding. Consumers and manufacturers alike are facing the stark realities of these challenges. For many, the promise of seamless transition to electric has been overshadowed by practical and economic hurdles. If you're seeking concrete evidence of this downturn, stay tuned as we delve into the numerous reasons behind this dramatic shift and examine how the industry's grand ambitions have met with the cold facts of market and technological limitations. Number 6. Frozen EVs and broken chargers. The recent dystopian scenes of electric vehicles, EVs, being frozen and stuck at charging stations have once again validated the skepticism of consumers who have resisted the shift to electrification. These incidents highlight a critical flaw. Electric cars still fall short of replacing traditional internal combustion engines. The reasons are manifold, but one particularly telling issue is the poor performance of batteries in cold weather. When temperatures drop, the advertised range of EVs decreases significantly, which has left many drivers stranded before reaching their charging stations. Those who did manage to arrive at a station faced further frustration. In Chicago last month, the cold snap not only caused many batteries to fail, but also severely impacted the performance of chargers. Some chargers were completely non-functional, while most others operated at reduced efficiency, leading to significantly longer charging times. In simple terms, colder weather demands more energy for charging EV batteries. Number 5. Manufacturers changing their plans. Not so long ago, many car makers were convinced of this EV transition, so they hurried up to take the best starting position for the new market. Of course, the largest American companies participated in this race as well, all of them wanting to develop as many EVs as possible in the shortest time. The boldest statements were probably those coming from Mary Barra, the chief executive at General Motors, who was promising full electrification by 2035. Meaning that no internal combustion vehicles would be produced by the middle of the next decade. Today, we're seeing numerous revisions of these optimistic plans. After a couple of years that were characterized by massive market growth, it looks like things are cooling down. We can talk about different reasons, but it all comes down to the lack of demand because consumers are far from being impressed with the EV offer these days. Most of them feel like they're forced to buy something expensive that doesn't give much in return. For most of them, it's better to stick to internal combustion cars as long as possible, and that causes problems for most companies. That's the main cause of revisions in plans, and as a result, reduction targets are significantly lower. Just remember that not so long ago, Barra announced a plan to sell 1 million EVs annually by 2026. Number 4. Job cuts. Even though the last year brought a notable increase in the number of new EVs sold, growth is much slower than most car makers were expecting. Consequently, most of them lowered their sales targets for the next year with notably lowered production. Of course, these revisions in plans cause a chain reaction, and one of these reactions is that many workers will soon lose their jobs. Many of them already did. Let's take the all-electric Ford F-150 Lightning as an example. This pickup is projected to succeed America's most popular pickup, but for this year, the production targets have been cut by half. So instead of rolling out 3,200 units every week, Ford's plant in Michigan will produce only 1,600 units this year and close one of 2 production shifts. From what we know so far, about 1,400 workers will be affected by this decision. According to Blue Oval officials, half of them will be moved to the nearby Michigan assembly plant to increase the production of the gasoline-powered Bronco and Ranger models. As for the other half, details are still unknown, but officials stated they'll be shifted to different jobs within the Rouge complex, which means that instead of producing electric pickups, These workers will now work in the production of the gas-powered F-150. Some workers will most likely lose their jobs, while some of them could also apply for retirement packages as part of the deal United Auto Workers signed last October. Number 3. EVs don't make profit. We could talk about the green agenda and the noble cause all day long, but the EV industry is a business above all. In other words, electrification must be sustainable and bring profit, which is not the case at the moment. EV makers are currently losing money on every EV they sell because they still haven't figured out the EV economy. They've been investing billions in new technologies, but haven't optimized the production process yet. With all that in mind, electric cars still cost a lot to make, and with a market pressure that forces manufacturers to come up with competitive prices and even offer massive discounts, it's no surprise that some of them have run out of investment money and now have to slow down. Ford Motor Company is one of the best examples, as the latest report suggests that the company has been losing $36,000 on every F-150 Lightning sold in the second half of last year. When we talk about overall numbers, some estimations suggest that Ford has lost around $4.5 billion on EVs in the last year alone. With that in mind, it doesn't surprise that the management has decided to push out money and postpone some of the major EV investments planned for this year. Similar things are happening in General Motors as well, so it doesn't surprise that this company also postponed some of the most important EV projects, such as the production of the electric Silverado and Sierra, as well as the production of a new drive unit, all in order to save capital. Interestingly, manufacturers are not the only ones losing money on EVs. Number 2. SUVs and pickups ruled the market. The automotive market has changed a lot over the last decade, and most consumers now prefer more practical body styles rather than traditional sedans, hatchbacks, and coupes. For that reason, it isn't a surprise that SUVs and pickups take up more than 80% of the market. From the EV perspective, that's kind of problematic because so far, electric vehicles have been small with a focus on efficiency. They aren't particularly generous with cargo space and aren't great in other aspects of practicality. To be fair, there are a couple of large and super practical electric SUVs on the market, but they're still too expensive and out of reach for a vast majority of customers. And while there are some indicators that more capable electric SUVs could come in the near future, things don't look so great in the pickup segment, and we know how important they are for Americans, because electric pickups are nowhere near as capable as traditional gas and diesel-powered units. Okay, they're quicker, but that doesn't really matter in the pickup world. What really matters is towing and hauling, and that's where electric pickups lag behind a lot. For example, the most capable F-150 Lightning can tow up to 10,000 pounds, while the gasoline version often goes beyond 13,000. But the max number is the least problematic thing. The main issue is with the battery, as it turns out that range drops significantly under heavy exploitation, which was confirmed by a couple of relevant tests. For example, Motor Trend took a trailer test and came to results that were beyond disappointing, as the claimed max range of 280 miles dropped to 90 to 115 miles depending on the trailer weight. Number 1. Government doesn't help enough. Officially, Biden's administration plans to make 2/3 of new cars all electric by 2032. Off the record, the government may be having second thoughts. There are a couple of quite indicative moves we saw recently, starting from the fact that the IRS has recently changed eligibility for a federal tax credit. As more domestic parts are required in production, many EVs don't qualify for a $7,500 tax credit anymore. Even Tesla has a couple of models that aren't eligible. Then there's the charging infrastructure. We've heard a lot of talk about the government's plans to invest billions in the charging infrastructure. But if we can rely on the report from Politico, even though Congress has provided $7.5 billion for new chargers, not a single one was built in the last year. This only makes us think that something really big is happening behind the curtain. So don't be surprised if the government eventually decides to give up on that fast electrification plan entirely.